Bankless Nation, this is Ryan Sean Adams. I have Michael Nadeau here from the DeFi Report on the podcast today. Michael, we are fresh back from holidays, man. How were your holidays? How was Thanksgiving? Did you get any weird crypto questions from your family?
Fantastic Thanksgiving. Appreciate you asking. I'm actually on the road right now down in Florida. But no, had a nice little break. Talked a little bit about crypto with the family. My dad's flying high. He's actually more of a gold bug. So he's pretty excited about gold right now.
Yeah, you should be.
Yeah, enjoying the break. Hopefully you have as well.
Yeah, I have, definitely. And hopefully your family members were following the DeFi Report, because you made some calls that actually held up very well, and they should be pretty happy for receiving them. There's a few things I want to talk about today on the agenda. There's definitely no sugarcoating it. Crypto prices are down bad. At the time of recording, we are well below 3,000 on ETH price. And I don't know, are we 85K, something like this on Bitcoin? We're recording this on,
I think so.
Yeah, Monday, December 1st. So we got to talk about that. It feels like investors are moving towards the acceptance phase, that this is more than a pullback, that maybe the cycle is over. So Mike, I want to get your perspective on what happens next. And one of the things you've done is really called this cycle better than pretty much anyone else I'm following closely. So I got to ask you how you saw this in advance, what data you used, and if some of that data can be used to help us predict the way out, the next leg up. Hopefully there's some hope here. And most importantly, I want to find out what you are doing now, when you're buying back in, and what assets you're looking at. You've told me before, Mike, that you actually get more energized during bear cycles, during the big long-term dips. So are you feeling energized right now?
You know, there's been a lot of negativity, on crypto Twitter, and I think people are a little soured by just price action out there. I do feel energized, and I think my sort of long-term bullish outlook for crypto hasn't changed at all. And I think the reason that I kind of enjoy the bear markets is just you get a little bit more clarity, especially for folks like me that are really focused on data and fundamentals. It's sort of easier to sort of see what's real once some of the froth gets kind of taken out of the markets. And so that's where a lot of the really strong sort of conviction thesis work comes into play. And I think the nice thing about these 4-year cycles is you sort of get a chance to kind of re-underwrite your thesis with these sort of little bear markets that we get. So I'm looking forward to doing a lot of that work over the next 3 to 6 months or so.
You also get the benefit, Mike, of some cheap prices, and certainly we're seeing those cheap prices. Before we get into this episode, there's a message from our friends over at the REYA protocol. They are a crypto perps trading application. Crypto perps trading has a problem right now. You think at the speed of a centralized exchange or the security of a DEX, which is often way too slow if you're trading in serious size. So REYA is closing the gap. They've got a first of its kind based rollup with ZK proofs. This is sub 1 millisecond trading, 0 trading fees. Also, because it's a base rollup, inherits Ethereum's uptime and security. That's 100%, by the way, so there's no sequencer risk. The market has noticed already. Perps are a pretty big deal, and REYA is now routinely in the top 5, top 6 perps dexes. They also have an upcoming token, which ETH maxis will love this. 80% of the token fees go to REYA. 20% is actually bought ETH. So they're going to buy back and burn ETH. If you want to go figure out what this is, get trading on REYA, you can do so. There's a link in the show notes, bankless.cc/REYA. All right, Mike, here's what we're going to do. First, I want to take some time to recap where we are. We had an episode over 30 days ago. I think it came out on October 21st. So what transpired since then? Then we'll get into where we are now. We'll zoom out a little bit, look at the cycle. And lastly, we'll talk about what's next and how to play it. You ready?
Sounds great.
All right. Where we left off, our last episode was right here. It was entitled, Is the Cycle Over? And I think my hope was no. And you were saying, yes. Unfortunately, Ryan, you have to accept the truth that the cycle very well could be over. Just to give Bankless listeners some context, you and I started doing these episodes on Bankless about 6 months ago. And the goal was really to use some of your insights to look at on-chain data to make better crypto investing decisions. And your orientation has always been long-term, perma-bull on crypto, but you play the cycles and you buy quality on the dips. So I said in the intro that you've been probably the most correct cycle investor that I've seen. And I think part of the reason for that is something we'll get into. I'm calling this cyclamentals, which is maybe the DeFi report's unique brand of using on-chain data to predict these cycles. So let's get into your calls back in October. Right now, of course, Bitcoin price looking kind of ugly, 84,000 at the time of recording. ETH price, 2,700 at the time of recording. Bitcoin is down 22% on the 30-day. Ether is down 30%. Other down market assets, of course, down to greater degrees. So this is feeling kind of bad right now. The first indication that I received that you were moving towards a risk-off position was this email that appeared in my inbox on October 10th, 2025, and it said, portfolio update, shifting to risk off. I looked at this and I thought, oh shit, Mike is going risk off. Last I checked, he was like, 25% cash, 75% crypto assets. So what's he doing? What's risk off? And you gave some reasons for this. You said Bitcoin had some lackluster trading volumes. Even it had kind of this run from 108K at the beginning of October, end of December to 125. You felt like that was lackluster, but mostly I think you were seeing a lack of demand signal. And there are a number of other things that maybe awoken you to the fact that something was feeling off in these markets, something was feeling kind of end cycle. And so you made a decision, I believe, on that Thursday to switch to a risk-off position and move to like 60% cash from 26% cash. And then that same day, later that day on Friday, October 10th, we had the 1010 flash crash. And it was pretty obvious that something broke in crypto. Maybe I'll just pause there. In early October, right before the 1010 event, what were you seeing in the markets that caused you to send this email and switch to a risk-off mode?
Yeah, so I think at the time, and again, always just kind of trying to play the probabilities, what we're looking at is really market structure for Bitcoin. And we look at a lot of these sort of holder cohorts to understand what the market structure looks like. And Bitcoin, had basically traded at an average price of about 102K over the last year from like October to October. And so all of the sort of new money that came into to Bitcoin at the time is coming in at that sort of elevated price range. And we could see that the sort of more longer term holders were exiting the market while that was taking place. So that the market structure was tilting more towards sort of like newer money, possibly weaker hands, sort of sitting at the top, while at the same time we were starting to get nervous about the amount of leverage that was in the system at the time. And so you kind of have this like kind of lopsided market structure set up with lots of leverage building. And then we were starting to get nervous that the liquidity conditions in the market were starting to sort of turn over. We're starting to see some tension in the repo markets, a lack of liquidity in the banking sector. And that sort of lined up with our view that like the on the margin, fiscal spend was sort of winding down, and you have tariffs also pulling liquidity out of the markets. And so when we kind of added all of these things up, we started to feel like, okay, the probability is actually pointing to a risk-off stance. That was the call that we made. We were sort of confident that every stage that we would expect to see play out in a crypto cycle had essentially played out, even though you didn't have sort of that euphoric period at the kind of like October peak, which I think was around like October 6th or so.
That's right.
So that was kind of the summary, and it's really kind of adding all of these things up to kind of land at like, okay, the probability points to risk off. We've had a good cycle. We were buying at the lows, and so it's kind of time to take risk off, and so that's what we did, and that's how we're playing these cycles. And now it's kind of pivoting towards where is fair value potentially going to come in for BTC if we are in fact heading into like a longer term bear market setup here.
So that's exactly right. So not only did you make this call in early October and interpret these indicators correctly, but you also did it with conviction. And I will say this was definitely a contrarian call in crypto circles. Like long-term bulls like me, I mean, we don't want to believe it that the cycle's over because the indicators had not been hit at the time. And so you came on the podcast. This was our monthly October podcast, or like into November, October 21st. And you were saying likely the cycle is over. At the time, though, this was even after the 10/10 event. It felt like a flash crash. Markets had partially recovered. And you were saying, hey, it's more than fair odds. My base case is that the cycle is over, unfortunately. But at the time of recording, Bitcoin was 110K and ETH was 3,900. So people kind of hated the episode, to be honest, Mike, right? And that's how you know you're at least in a contrarian place. Turned out that call has been contrarian right. And we'll talk about, maybe that was your October call. And let's talk about November, because November was, I think, the market scratching its head and waiting for a confirmation. This is probably you looking at some of the data and waiting for a confirmation as well. So you had this November 5th report on the DeFi report website. And the title was, Has the Bear Market Arrived? At the time, you were like 75% cash, I think. So you had already placed your bets that basically it looked like it. But you were open to alternative data. And you said this, the bull market structure hasn't technically broken yet. We're looking for weekly closes below the 50-week moving average. At the time, that would be about 103K Bitcoin. You're waiting for that, the 50-week moving average, 2 closes below for confirmation. But you said your base case is the cycle is over, and you're open to data proving otherwise. Let me just ask, this chart, the 50-week moving average, this is, folks are looking at the chart, this is from the early November. Have we broken those weekly closes of 50-week moving average for Bitcoin being below the 50-week moving average? Has that now happened yet? Do you have the confirmation you were looking for in early November?
We do, yeah. So we do have this confirmation. The 50-week moving average is around the 100K mark, and so that has served as, in the last few cycles, that has served as bull market support. We can see that in the kind of the green arrows there. We've kind of been bouncing off of it whenever Bitcoin has a little bull market correction. We now have broken through that. So now, and we've had multiple weekly closes on that. And I think, the market sold off pretty hard last night.
Yes.
And, we had a big sort of monthly close at, Sunday, 8 p.m. last night. Came in kind of lower than I think the market was hoping for. So it looks like some of these critical resistance points are turning into resistance and not support. What I would have been looking for to potentially change my mind would be that, okay, maybe we reclaim that and it starts to serve as support. Then you can start to turn bullish. But seeing it get rejected and then the market reaction to that with a pretty hard sell-off last night tells me that this is deteriorating further, and it's sort of the probabilities of a sort of a longer term bear market are starting to be confirmed for me.
Okay, so this November was definitely confirmation. And by the way, this 50-week moving average, why is that important? My understanding is that the past cycles in crypto, every time we've had at least 2 weekly closes, multiple weekly closes, below, for Bitcoin as below the 50-week moving average in the 4th year of the cycle, it's been over. The cycle's been over, and then we see kind of a more prolonged bear period of time where prices dip, and we get kind of very negative sentiment for 12 months or so. So that has always been the case in previous cycles, and you're just saying now we have that confirmation here, and you're saying that's like it's always been the case previously. So why wouldn't it be the case now?
Yes, I think so, but it's also, I think, important for people to maybe, it's one indicator, and we're looking at a number of data points here, but this, if we want to sort of go under the hood and think about this one indicator and why it tends to work, I think it comes back to the market structure, and what we talk about in terms of the sort of holder base and how that has sort of gotten lopsided. So if you think of the 50 week, that's about a year's worth of moving average. And I was mentioning earlier, over the last year, the average price is about 102K or so. So all of the new money that came in is coming in at that higher level. And now we're sort of breaking off of that. So that holder cohort is now, has an unrealized loss. They're sitting on losses. And what tends to happen is when we break down from that, we will see some bear market rallies. And what I'm looking for is like when you get those bear market rallies, are these people that came in like as tourists over the last year, are they selling as we get the bear market rally because they just want to get out at like a, as close to break even as possible? I think that's the sort of market structure that sits underneath, that indicator of the 50-week moving average.
Okay, so that's what you mean by market structure. So it's not just one particular like technical analysis indicator and a moving average indicator. This gets into kind of maybe your brand of fundamentals, what I called earlier in the episode, the TDR cyclamentals, which is you're using some of this on-chain data to kind of predict the stage of the cycle, right? That's the cyclamental. And something that has come across in all of your work, like this post that you wrote in mid-November, the question of the Bitcoin market structure, you said the Bitcoin market structure is broken. When you say market structure, you're really talking about this long-term holder activity. I know that's just one data point among many, yet your work seems to focus on long-term holder activity and in general holder activity more than I think any other cycle analyst I've seen in the space. Why? Why is on-chain holder activity so important to you? And was that the key data set that you used basically to make these calls in earlier October?
I think so. Yeah. So I view this data. This is like a gift that we get with on-chain data. And I was actually sort of having a conversation with some family members over Thanksgiving about imagine if you could tell what the sort of holder base of the gold market looks like right now.
Yeah, your dad doesn't have that, right?
Yeah,
he doesn't have that insight.
So this is like this is kind of like a little cheat code that we have if you have access to this data to be able to see actual market structure. There's plenty of analysis that we're also doing on, looking at the macro setup and looking at the business cycle and looking at all these other things. But then we can come back to this and say, well, if we don't feel really strongly about the macro setup, the liquidity setup, and we know that the sort of the market structure has shifted to this sort of like lopsided, top-heavy structure, then it just adds to that conviction. I think that's what allows us to kind of make those bets that maybe seem to be really bold, contrarian views, but for us, it's just, hey, this is what the data is telling me.
But why is it? So we have this data. It's a gift that we have in crypto where we can track holders over time and how long they're holding, and kind of they're sort of a proxy for cost basis of the cost at which they acquired the assets, whether it's Bitcoin or Ether or some other crypto asset. So we have that data. We don't have that in other markets. You don't have that in equities. You certainly don't have that with commodities or gold. We have that in crypto. But what's the intuition as to why it should be the case that long-term holder activity, and whether they are accumulating or whether they're selling, why should it be the case that actually dictates the cycles here?
Well, it doesn't have to. It certainly doesn't have to. And I think the way that I would think about this is like, if we know that historically long-term holders tend to come in and sort of set the bottom of markets, they tend to sort of, exit markets when there's a separation between their cost basis and kind of the market price. I think, if we know that that's sort of the probabilities, we could say, well, wait a minute, how could we be wrong on this? What would it look like if we're actually wrong about this? And I think that's where you have to have some clear catalyst for a new wave of money, or there's new money, there's a new buyer, something happened, whether it's in the regulatory or that you feel confident that there's a new buyer that's happy to buy Bitcoin at 100K or so, and we couldn't really find that catalyst. Sailors, kind of tapped out. Most of the debt buying, had sort of played out, over the summer months, and so I think that was the factor where it was like, okay, we could be wrong about this, but what is the catalyst? If you have to replace what typically is the market participant that sets the bottom, who is going to do it? We didn't have clarity on that.
Okay, so you didn't identify a source of demand, but it does seem to be the case that Bitcoin assets and maybe crypto assets more generally, because Bitcoin kind of moves the liquidity of the entire crypto market right now. It seems that it happens in these like accumulation adoption types of waves. Yep. With different cohorts across each cycle. And maybe that's just a structure of the market. Maybe that's the market structure. So first you have like weird crypto anarchists and early believers, and Maybe then at some point they kind of exit some of their assets to sort of the early hedge funds and early VCs, and they sort of exit to the next. And now we have, it seems to be the case that we have some larger institutions, not maybe the largest institutions in the world. We still don't have kind of the sovereign funds maybe have not entered in size, but we do have the BlackRocks of the world. And that demand source has now exhausted, but kind of the earlier adopters have sold into that net new demand source. And now the demand source is exhausted and we kind of roll into another cycle. That's essentially maybe the narrative story for why this on-chain data actually matters for you.
Yeah, I think so. I think that lays it out pretty nicely. And something that we should also mention here is that this is constantly evolving, right? So we are looking at, when we look at this Glassnode data here, and really the holder cohorts, this is on-chain only. So there is a growing part of the market now that's, as Bitcoin gets more financialized, you have the ETF products, about 6% of the supply is now held in those ETF products. And so this is potentially getting more challenging as we go, as Bitcoin becomes more financialized, and almost like some of these KPIs become a little bit more off-chain. So that's not something I'm looking forward to as an analyst, right? Because this is fantastic data for us, but it's something we do factor in, and we've actually been doing some work to actually try to understand what's the sort of average cost basis of the ETF holders as well. But yeah, I think just kind of the way you're laying this out is correct, and I just view this as like it's out there, it's available. This is unique data. You can't get this type of data in the traditional markets, and I find it like really, really helpful, even though it's not perfect either. Like these are sort of proxies for what we think the cost basis is and what we think sort of the setup is with different holder cohorts. But it does tend to provide really, really good signal over the last few cycles.
Ethereum's layer 2 universe is exploding with choices. But if you're looking for the best place to park and move your tokens, make your next stop UNICHAIN. First, liquidity. UNICHAIN hosts the most liquid Uniswap v4 deployment on any layer 2, giving you deeper pools for flagship pairs like ETH USDC. More liquidity means better prices, less slippage, and smoother swaps. Exactly what traders crave. The numbers back it up. UNICHAIN leads all layer 2s in total value locked for Uniswap v4. And it's not just deep, it's fast and fully transparent, purpose-built to be the home base for DeFi and cross-chain liquidity. When it comes to costs, UNICHAIN is a no-brainer. Transaction fees come in about 95% cheaper than Ethereum mainnet, slashing the price of creating or accessing liquidity. Want to stay in the loop on UNICHAIN? Visit unichain.org or follow @UNICHAIN on X for all the updates. You can now borrow USDC against your Ethereum and Bitcoin on Coinbase. Crypto-backed loans on Coinbase make assessing liquidity seamless for crypto hodlers. Powered by Morpho, Coinbase crypto-backed loans gives you direct access to on-chain financing, allowing you to take out loans at competitive rates using your crypto as collateral. Over $1 billion in loans has been opened through Coinbase to date. On the Coinbase app, eligible users can borrow up to 1 million USDC using Bitcoin or Ethereum as collateral. Users can convert their USDC into fiat to make down payments, refinance debt, or cover urgent expenses, and more. The benefits are numerous. Interest rates are variable, typically between 4 and 8%, and respond to market conditions. Loans are approved in seconds without credit checks. Repayment schedules are variable, meaning there are no fixed deadlines. The kicker? Coinbase will not treat borrow transactions as taxable events. Manage loans directly in the Coinbase app with ease. It's currently available to US customers, except New York, and additional collateral types and increased loan limits are coming soon. Want to learn more? Click the link in the show notes or visit coinbase.com/borrow. Introducing FRAXUSD, the genius-aligned digital dollar from Frax. It's secure, stable, and fully backed by institutional-grade real-world assets, custodied by BlackRock, Superstate, and Fidelity. It's always redeemable one-to-one, transparently audited, and built for payments, DeFi, and banking. The best of all worlds. At the core is FRAXNET, an on-chain fintech platform built to align with emerging US regulatory frameworks where you can mint, redeem, and use FRAXUSD with just a few clicks. Deposit USDC, send a bank wire or tokenize treasuries, and receive programmable digital dollars straight to your wallet. FRAXNET users benefit from the underlying return of US treasuries and earn just by using the system. Whether you're bridging, minting, or holding, your FRAXUSD works for you. Frax isn't just a protocol, it's a digital nation, powered by the Frax token and governed by its global communities. Join that community and help shape Frax Nation's future by going to frax.com/r/bankless. Frax, designed for the future of compliant digital finance.
All right, so that's a recap of where we are now. Let's zoom out on the cycle for a minute. And you wanted me to include this slide, the classic psychology of a market slide, where Hopefully everyone is seeing this on screen on YouTube or Spotify video. But this is the classic disbelief, hope, optimism, belief, thrill, euphoria, and then the market spikes up, and then you get complacency, anxiety, denial, panic, and then it levels off into anger and depression, right? And that's a full cycle of a bubble, basically, or any large market cycle, and something that we've seen recurring in crypto. I guess my question, as we look at the psychology of a market here, Mike, is okay, where are we now? Where would you place us?
I think we are, what's kind of weird about this is that we didn't really have the euphoria in October. When I think about when I think about the cycle, I sort of think of the euphoria really came really Q4 of last year into January, into sort of when Trump was coming into office. We had the Trump meme coin launch, and that was kind of when that was probably the most euphoric period of the market. I think this threw people off a little bit, but I think it was kind of similar to what we saw in the 21 cycle as well. I think the first peak was in April of 21, around when Coinbase went public, and I think that was really sort of the euphoric top of the 21 cycle. We did end up going back and getting up to like 66K, but it was kind of a muted sort of end to the cycle. And I think we had a similar setup that actually played out in this cycle. I think that threw people off, just that we didn't see that sort of euphoria, at that time. I think we are in complacency now, and I think that was sort of the conclusion that I was coming to even back in early October, that the market was too complacent, and that there was quite a bit of pushback on sort of my view at the time. I think that is becoming a little bit more consensus now. But as this plays out, as Bitcoin, it continues to drop or sort of chop it around in the 80s, and the longer it goes, and it's sort of breaking these technicals and the market structure that people are looking for to confirm maybe a more bullish view, then we start to get into the anxiety phase, and that's when maybe people that came in over the last year, when they see like a little bear market rally, they kind of want to get out, and that starts to kind of fool the market a little bit. I saw somebody come up with an analogy for bear markets, and it's kind of like, think of it as like a bouncy ball, like going downstairs. Like it's going down, but you do get these bounces where things come up, and it's that the market structure is such that I'm concerned that these like sort of weaker hands might just try to look to get out, and then once that's all done, and we get, maybe we still don't know if there's bad debts out there that sort of need to come to the surface and things like this. This happened in the last cycle. We had a number of like CFI companies that were in trouble, and that all had to get reconciled. And you typically have a few more legs down as that plays out. So that's sort of the setup, moving forward. And I think the market is, based on what I'm seeing on X, we are certainly not in the greed, buy zone anymore. It does seem like we're kind of coming off to the right side of that chart.
Definitely, yeah. I think October maybe was more complacency and then some denial. Now I feel like we're in anxiety mode and denial. I think a lot of the folks listening to this are probably anxious listening to you as you speak here. So that indicates where we are. Maybe not quite panic, although I don't know how much of a panic we'll get this cycle. But it is roughly, the psychology here is roughly playing it out as it has in previous cycles. Let's maybe map this to your idea of the stages of a cycle, right? And so talk about this chart. You've got 4 different stages of the cryptomental cycle, let's call it, or cyclomentals part of the cycle. You've got the early bull, you've got wealth creation, you've got wealth distribution, and I'm guessing we are now in the wealth destruction zone, October 25th. So talk about this, and why are you putting it on this specific chart? Is this a price chart?
Yeah, this is a price chart. So this is kind of like the 25 cycle here. So it's kind of starting in early 23 when Bitcoin had just kind of bottomed after FTX, and you had this early bull period, which was really kind of like the first part of 2023. And like something that I always come back to with sort of the early part of markets and also the later stages of markets is that most market participants will be late to actually acknowledge a bull market in the early stages. So an example of this is like, by October of 23, Bitcoin was up 100% or so on the year, but I don't think people sort of
They
on
did
crypto
not feel
Twitter
bullish
did
at
not
all.
feel bullish, right? It was still kind of like, it's almost like people don't want to admit the bull market's on until you actually go back to all-time highs and cross over all-time highs.
But
even though
also, they just open their portfolio tracking app and they see that they're still down. They're still down from the previous all-time highs. So
Right.
they don't feel bullish because they
Right.
didn't position themselves in a cash position across the cycle, and they weren't buying that, October 23, that Q1 October 23 play there. That's
Right.
probably why.
There's no FOMO at that point, right?
Yes.
And that's the interesting thing to me, is that you could be up 100, up 100% off the lows, very little FOMO. So that's kind of the early bull period. And then, in this cycle, the wealth creation period was sort of an interesting period because we had the Bitcoin ETFs came out, and that happened before the halving occurred. And we actually went to all-time highs before the halving, which is the first time that's happened. And so that was another, period where, okay, now people are feeling good. I think everyone's back to, just feeling good about where the markets are. You're probably getting more FOMO at this stage, as the price of Bitcoin's probably moving past sort of the average holder's cost basis, and people start allocating again. And then this starts pushing.
That was a move from like 35K Bitcoin all the way above 100K Bitcoin by January 2025. So, and the 100K felt like quite a milestone to be above that for the first time.
Right. And by the end of that, by the time you got to January 25, a lot of the people that were buying in the early bull, some of them are happy to exit. They're up 5x or so. They're happy to exit. So you're already starting to get like we talk about market structure, you're starting to see the market structure turn over once you get to those elevated levels. And that's the thing to pay attention to, because that leads into the wealth distribution zone there, which played out over the last year or so. And we can get into some metrics that we look at in terms of like the cycle metrics here. But as you get into wealth distribution, this is part of the reason we didn't get the euphoria, is like long-term holders were happy to exit at, 3 to 5x gains, but we didn't have the new buyer coming in at that time to really steady the ship and allow us to go to new highs. We did have a lot of leverage in the system, I think, because of the DATs. And I think people got complacent, thinking that there's a price agnostic buyer in the market with these DATs. Let's go ahead, let's put the leverage on. A lot of this was more in altcoins. And then that leads to those big liquidations, which I think that the one that we had on October 10th really kind of broke the market structure, broke the psychology of the market a little bit.
So January 2025 to October 2025 is a wealth distribution phase. And now we're in, presumably, if all of this is lining up correctly, you think the weight of probability is we're in a bear market wealth destruction phase for 9, 12 months? Maybe we'll talk about the next early bull market indicators in a moment. But is that how you're anticipating this plays out, the wealth destruction?
Yes, I think we are sort of in that zone right now, and I know people don't want to hear this. Doesn't feel good hearing it. I think that's kind of where we sit, and we can get into kind of what's coming next, I think.
Before we do, though, you mentioned the cycle key performance indicators, like the main metrics that you're looking at for 2025, and these are some of the on-chain metrics. So I guess this is mapping them to the different points in the cycle, right?
Correct.
So for each metric, we're looking at early bull, wealth creation, wealth distribution, and then where we are today, presumably early wealth destruction phase, let's say. So what are these metrics, and like how would you explain these numbers across the different phases?
Yeah, so this is kind of what we use. This is just a small sampling of some of the data points that we look at. But as you can see, so if we just look at maybe the market value to realized value, the MVRV there, that is measuring, what we think the average sort of cost basis of the network is relative to the market value of the network. And so we always want to buy Bitcoin when it's under 1, because that means sort of on aggregate, as a proxy for the average cost basis, the price is below that. So in the early bull, Bitcoin price back in early 23 is, just around 20K or so. And the, average cost basis of the network is sitting around 24K or so. So when you have that disparity, that's like a flashing green sign to go ahead and buy Bitcoin in my view. And then as you can see, as you go to the next stage of the cycle of wealth creation, you can see now you're above one. So maybe it's not like perfectly fair value to be buying Bitcoin at that time, but you are in a bull market structure. It's pretty, you can still buy Bitcoin. Then you're probably buying it at, 50K or somewhere at that stage, and you still have some nice upside left. But then as you get into wealth distribution, you can see the market value has now detached considerably from the average kind of cost basis of the network. We only got up to about we didn't even hit 3 as a peak in terms of that ratio this cycle. So we were expecting it to get a little bit higher earlier, when we were making our calls earlier in the cycle. And so it was slightly muted, and then you can see now it's starting to trail off. It's kind of going in the opposite direction. So that's just kind of one metric that we look at. We're also looking at the we talk about market structure. A lot of that is looking at the percentage of the Bitcoin supply that's held by long-term holders, versus short-term holders. And you can see there's kind of like a process here where in the early stages of the cycle, you tend to have a much larger base of long-term holders dominating the market. And then as you go later into the stages of the cycle, those folks exit the market. And so you can see the percentage of long-term holders starts to decline as you go through the cycle. And then we can also look at are they in profit or are they in loss? And you can see a story there where when you're at the bottom of the market or the early bull, a decent percentage of even the long-term holders are actually at a loss. And then, as you go through the cycle, that comes down. Typically, you get to a place where actually 0% of the long-term holders are in loss. That's once you get up to all-time highs again. Today, we're at 12%. So now we're kind of going back in the other direction. So these are some of the key metrics, and this is just how we anchor. And it allows me to sort of sit back and have conviction over, because we know what the return profile can look like based on these types of metrics over a 1, 2, 3 year periods.
And so this is also an indicator of when you should buy back in, I suppose,
Correct.
which we'll
Correct.
maybe talk about. One question before we discuss what's next and how you think about this. Part of the narrative that you're talking about long-term holders basically selling, basically exiting their positions to the newer entrants in the market. There was an article that I read, I think I mentioned to you, by Jordy Vasir. It was entitled Bitcoin Silent IPO, Why This Consolidation Isn't What You Think. Now, he was setting up this article to say, hey, this is just a temporary bump in the road, a temporary dip, and longer term, things get bullish. I think he was maybe talking about some more shorter term. He wasn't predicting a bit end of the cycle as maybe you are, but he was saying effectively that early Bitcoin holders, this is kind of their IPO moment, basically, where you've got ETFs and they're exiting to newer holders. And is that what you're seeing in the data? Effectively, did whales and long-term holders kill this cycle? Is the Bitcoin silent IPO narrative correct?
I think there's some nuance here, and I read Jordan's piece, and I thought it was a well-written piece. He didn't have a ton of data in his piece, so this is something we've been tracking, and we're following this structure, and we've been pretty vocal saying, hey, yeah, long-term holders are exiting the market. The structure is a little bit lopsided, but is that actually materially different from what we saw, at the peak of the 21 cycle? That's really what I wanted to investigate a little bit further. And, my conclusion here is that probably not. There did look to be a little bit, higher levels of kind of inactive supply. So what we're looking at here is total supply that was inactive over a 3 to 10 year period. So this is the stock of Bitcoin that has been inactive over from a 3 to 10 year period. And so we kind of look at this to get a sense for did this come way down in this cycle relative to the last cycle or the 17 cycle. You can see the blue line kind of goes up as coins age into this cohort, right? As time goes on, more coins that haven't moved are aging into it, it's growing. And then as Bitcoin kind of goes into price discovery mode, you tend to see that blue line drop down where those red arrows are. And you see that kind of on the backside of each cycle. We can see a pretty significant move there in the 17 cycle, a much smaller one in the 21 cycle. And I think, I'm kind of like guessing here, but it feels to me like there were a lot of whales that probably thought that Bitcoin was going to get to 100K last cycle and were maybe planning to sell at that point, but never got the chance to. And those whales seem to have, stepped in and made their coins active again. And that's what shows up in the data here. But why don't we flip through a few of these slides because we can kind of start to tell a story here. So what we did there, we just kind of looked at the chart to see if there was anything visually that's like really making us think that there was a big change this cycle. What we're looking at here is we're actually quantifying the total amount of coins within that 3 to 10 year inactive supply cohort that actually became active in the year before the price peaked over each cycle. So we're doing like a relative comparison in terms of the total number of coins within these inactive supply cohorts that actually became more active. And then we're normalizing that to the amount of the total Bitcoin supply at the time of the price peak for each cycle. And so we can see that actually this is sort of interesting because the amount of inactive supply actually grew in the year leading up to the 2021 peak. So more coins were just aging into this cohort. And it tells you that maybe there wasn't a ton of selling or a ton of movement of these coins. And we can see that in this cycle, about 2.9% or so of the circulating supply actually moved within this cohort. So that tells me, okay, that looks like, maybe that narrative is correct. And this is the key thing to pay attention to with those stats is that's just tracking movement of coins. It's not telling us for sure if somebody sent their coins to an exchange.
Sure.
It could just be somebody, moving some Bitcoin from one wallet to another and they didn't actually sell, but it's going to show up in that data. So I wanted to then look at, hey, can we confirm that with like what we know to be actual transfers from long-term holders to exchanges? This gives us a totally different view. It actually looks like there was less movement of coins that went to exchanges. This data is going to pick up everything that was a direct transfer to an exchange. It's not going to pick up an OTC sale, for example. And this just kind of gets into a lot of the nuance with this data. And an example of an OTC sale that wouldn't show up there would be like Galaxy processed like a $9 billion
Yeah, I remember
sale
that one. Made
in
big
July,
headlines.
right?
Yeah.
So that would show up on the revived supply, right? It's going to show up on this chart, but we're not going to see it on the transfer to exchanges because that was an OTC sale. So that's why we look at both of these. There's a lot of nuance here because I think a lot of people will see people putting charts up on Twitter or something, and it just it's easy to sort of look at that and say, oh yeah, that's obviously what happened. But there's quite a bit of nuance to this.
I think
data.
Maybe what you're saying is, so the question of did whales and long-term holders kill the cycle? Is the answer to your question yes, but not any more than usual. This is how cycles always end. So this was nothing special. This is always how they end. And of course, long-term holders are selling to shorter-term holders.
That's kind of how I think of it. Like I didn't find anything that like totally jumped out to me. And the reason I say this is that, to me, it's really more about there's just, you lost the marginal buyer.
Right.
You lost the marginal buyer. And like, it wasn't an issue when, in July, when you had someone dumping $9 billion of Bitcoin, we were at 117K Bitcoin. The market absorbed that pretty well back in July. But that's, once we kind of moved through that, there just wasn't that marginal buyer to capture that. And so So yes, there were certainly, large whales and long-term holders that were selling. I think it was mostly in line with what we've seen in past cycles. And just like in past cycles, they tend to end when the marginal buyer just isn't there anymore. So
for all the talk, this cycle has played out a lot like previous cycles, right? I mean, we
Yep.
didn't get some of the euphoria, or we didn't feel like we did, but everything else has played out pretty, pretty standard.
Imagine a world where traditional finance meets the power of blockchain seamlessly. That's what MANTLE is pioneering with blockchain for banking, a revolutionary new category at the intersection of TradFi and Web3. At the heart is UR, the world's first money app built fully on-chain. It gives you a Swiss IBAN account, blending fiat currencies like the euro, the Swiss franc, the United States dollar, or the renminbi with crypto, all in one place. Enjoy real-world usability and blockchain's trust and programmability. Transactions post directly to the blockchain, compatible with TradFi rails, and packed with integrated DeFi futures. UR transforms MANTLE Network into the ultimate platform for on-chain financial services, unifying payments, trading, and assets like the MI4, the METH protocol, and Functions FBTC, backed by developer grants, ecosystem incentives, and top distribution through the UR app, reward stations, and Bybit launch pool. For MNT holders, every economic activity in UR drives value back to you, embodying the entire stack and future growth of this super app ecosystem. Follow MANTLE on X at @mantle_official for the latest updates on blockchain for banking. That's x.com/mantle_official. Crypto is risky. Your sleep shouldn't be. 8 Sleep's mission is simple. Better sleep through cutting-edge technology. Their new Pod 5 is a smart mattress cover that fits on the top of your bed. It automatically adjusts the temperature on each side so you and your partner can both sleep the way that you like. It's clinically proven to give you up to 1 extra hour of quality sleep per night. 8 Sleep's Pod 5 uses AI to learn your sleep patterns, regulate temperature, reduce snoring, and track key health metrics like HRV and breathing. With a new full-body temperature-regulating blanket and built-in speaker, it is the most complete sleep upgrade yet. Upgrade your sleep and recovery with 8 Sleep. Use code BANKLESS at 8sleep.com/bankless to get up to $400 off the Pod 5 Ultra during their holiday sale. That's 8sleep.com/bankless. You also get 30 days to try it risk-free. Link in the show notes for more information.
Let's talk about what's next. And one of the other indicators that I know you look at besides the on-chain data is macro indicators like Michael Howell's Global Liquidity Index. Can you talk about global liquidity and how that factors into what you think happens next for crypto? So weight of probability is we're in a bear market. What do you think the global liquidity conditions will be?
yeah, and I recommend, I know you interviewed Michael recently, so I recommend people check that out. We source from a lot of his work, and I think this is really helpful to sort of map out not just what we look at in terms of the crypto native data, but then to kind of come to conclusions about where we think we are in these liquidity cycles. And when we were kind of getting a little bit concerned, late September, early October, we were starting to see the signs that the global liquidity cycle might be sort of, topping out. And, I always want to understand why. I'm not just going to look at the chart and be like, okay, it's topping out. What's actually going on under the hood here? And to me, we're in a period of transition, and a lot of this has to do with the Trump administration, tariff policies, and really what's happening in terms of the fiscal side of what we're seeing from the U.S. government. And I think it's probably not a super well-known thing that the fiscal deficit actually came down for FY25. Trump was only in office for about 2/3 of that. That ended FY25 ended at the end of September, and so we're still running a big deficit, but on the margin it's actually coming down a little bit. Part of that's because tariff revenues are increasing, and then the other part is that the spending levels are just not growing at the same rate that they were under Biden. And so when you add those two things up, that is liquidity negative to the markets, just in terms of what we're seeing on in the United States. I think there's this view that we have a new Fed president likely coming in. It sounds like Trump is close to making a decision on this person. Market expects this person to be very dovish, lower interest rates, and I think that is the setup. But I'm not convinced that is going to actually be really positive for risk assets. And part of the reason for that is if you have less capital going into the markets from the Treasury in terms of just Treasury spending, and on the margin, that's just not growing as much. If we see a Fed president come in and cut rates, 100 basis points or so, that's going to be even less. That's, that potentially is going to increase and boost liquidity with bank lending, but you're actually lowering fiscal spend, right? Because we're paying interest on $38 trillion of debt. And so if you drop that by 1%, that's hundreds of billions of dollars less going out into the economy. And I don't think the market is really appreciating this. It's sort of just, it's going to be, the dollar's going to drop, interest rates are going to drop, good for risk assets. I'm not sure about that. And that's part of the reason that even with this sort of like more maybe, dovish Fed president coming in, we're not, convinced that this is going to be great for liquidity and great for markets.
So you think the GIL, this global liquidity index, Michael House, will continue to kind of like taper down, at least for a while? Like we're at the end of one large cycle and there's going to be a drawdown first before there's an reinjection of global liquidity.
That's basically my base case. And this is global. So it's factoring in all of the major central banks and, what China is doing and everything as well. But we really think the United States is kind of driving the bus. And, we tend to have these, sort of periods of transition. We had one when Biden came into office during the midterm year where we had to kill inflation. And so it was a little bit of a different transition where the Fed was hiking rates, and you had, we were ramping up fiscal spend, and then we were hiking rates. This time we're going to be dropping rates and lowering the fiscal spend. But I think the outcome is going to be a bear market for each scenario.
That's interesting. And that's why investors should stay tuned to obviously your work, but also Michael Howell's work, because like, I think if you look at the headlines and you're like, oh, well, Trump is just getting a very dovish Fed chair next, and we've already started the rate cuts. And so we're just going to cut. Well, what if those cuts actually don't impact global liquidity in the positive way? What if global liquidity, the big picture story is actually it continues to taper down? Well, it doesn't do what people expect. And that's why they need to dive a little bit deeper on some of these numbers. Okay, so the setup, we've looked at the on-chain data. We've talked about global liquidity. So that is going down. So I guess what's next, it sounds like, is some sort of prolonged, measured in months kind of bear market. Can we talk about how to play this? So I know your style is to look at the cyclamentals and like trade these things, trade kind of the 4-year, the 6-year, whatever it ends up being, rather than buy and hold. Some people listening to this might just be like, Mike, this is still too complicated. You got lucky. Okay, good calls in September, October, but you kind of got lucky. I'd rather just buy, hold, dollar cost average my way through these cycles. That's how I've always done it. What do you think of buy and hold versus a trading these cycles type of strategy?
I don't hate it. I definitely don't hate it. I think it's definitely a personal decision for people. And there's kind of a few schools of thought that I guess I have around this. For me, I prefer to try to buy, the lows and have conviction and look at, be rooted in data to do all this. And then, try to get out of markets once we think like some of the sort of bull market metrics are being hit. The reason I like this is I think you can get better returns. I like the idea of being able to sort of re-underwrite the thesis, every few years as we kind of go through cycles.
Because different cycles have different winners too, right? I mean, presumably Bitcoin and Ether, they win some set, but then there's going to be some breakouts down market.
100%. And that's the other piece of it is like, we're still so early in crypto. It's hard to be like just fully long-term on anything besides maybe like, Bitcoin and maybe a couple of the majors. And so we do think there's going to be, new assets that come in and new projects that we will likely be interested in. So it gives us a chance to kind of step back, book some profits. But at the end of the day, what we're trying to do is increase, the amount of Bitcoin that we're holding through cycles, improve our returns, and then be able to underwrite maybe other big bets as well. I get that this is complicated. This is something, we're in these markets looking at data every day, doing this 24/7. If you're just a professional and you're, just looking to kind of build some wealth, by holding some crypto assets, maybe it is better for you to just try to buy when you think you're in a bear market, and some of these like more fair value metrics are being hit that we report on, and maybe you don't sell. Or you sell maybe a very small amount, and then you just try to acquire more again in the bear market. So I think there's different ways to play it, and it's kind of a personal decision. So
okay.
Yep.
Just as I've watched you play it through the DeFi report, and all DeFi report subscribers, of course, get access to your portfolio on kind of like a weekly basis, or if there's some sort of catalyst type of event. You've been in your risk on mode. You were like, you're close to 15%, 20% cash, and the rest fully deployed into crypto. After the events of October, you've kind of reversed that. And I think, October, the morning of October 10th, you were like, 60%, 50 to 60% cash, something like that. And the rest crypto. Now you're 80% cash and 20% crypto. And that's really how you play these cycles, right? You want to be primarily cash so that you can redeploy into cheap assets with strong fundamentals. And fortunately, that's the position that you're in. And I guess listeners, their case will somewhat vary. But now, for those with some spare cash looking to deploy across this cycle, let's talk about when maybe they should deploy, at what price point. So you wrote this post, there was a report earlier in the month of November, which is like, what would it take for Michael Nadeau to turn bullish? Like at what price point? What are you looking for? Maybe we'll talk about Bitcoin. You said, we can track several key indicators to gauge where we are in the cycle. In bear markets, we expect the Bitcoin price to drop somewhere near the intersection of the realized price and the 200-week moving average and the cost to mine one Bitcoin. You also said there were some additional indicators that you were going to look at, like the 40% of long-term holders in profit, price below the ETF average cost, which gets into some of the off-chain metrics, I guess, price below the Sailor and the MicroStrategy average cost, and the 12-month RSI approaching 40. And so that's when you are going to start to get bullish. I read a Chris Branitzky post, I think he put this out on November 20th, and he said, there's so much pessimism and short-term thinking on crypto assets, you can start to get tilt towards long-term optimism. That said, not yet. He said, I shared my view, 109K, that Bitcoin only starts to get interesting below 75K. So he's saying Bitcoin starts to get interesting below 75K, and a revisit of the 200-week simple moving average is always possible, which is at about 56K currently. So below 75K, Chris is a buyer. What about your indicators? What price point are you kind of looking for, and what metrics are going to tilt towards, okay, Mike is back on, nibbling on in the risk on mode?
Yeah. So the 200-week moving average is definitely a really good one. And I like that Chris mentioned that. That's around 57K or so right now. And Bitcoin actually dropped below that in the last cycle. It was the first time it actually dropped just below it. I think that's going to probably, it's a rising, it's a moving indicator. It's rising over time. I think that's probably going to land somewhere around 65K or so over the next 6 to 9 months or so. The realized price is also actually sitting around 57K right now. And so I think, that's also a rising number as new people come in and buy at these more elevated prices. And so I'm thinking we're probably going to see an intersection somewhere around 65K or so. So I will probably be getting interested, similar to Chris, around the 75K level, and then looking at all these metrics, looking at market structure, looking at sort of the outlook for macro and everything moving forward. But these are the areas I would say that we're targeting. I think I would be very happy to be able to buy Bitcoin at 65K. That is that's like a 50% correction. So it's actually a lower correction than we've seen in the past. I think we went down 75% in the last cycle, closer to 85% in prior cycles. So this would be a much shallower bear market for this cycle.
Well, do you think that could be the case, since we never got the heights of a super euphoria? Maybe during the bear market we don't get the depths of a super despair, and it's sort of a shallower high and also a shallower low.
It makes sense to me that would be the case. Exactly. You didn't get the euphoria, and just because of what we've been talking about, the market structure, that you're actually going to be setting like kind of a higher base, I think. And this should continue as we move forward, and we could just continue to see even less elevated bull markets and maybe quite slightly shallower, bear markets as Bitcoin continues.
But Mike, you do expect this to take some time to play out, because for all of the reasons we mentioned already, it's just because sellers have to feel that point of kind of exhaustion and despair and just like check out completely, and the tourists have to leave, and then you have to start a floor of now the long-term holders are coming back in and they're saying, hey, it's still here, crypto's still here, it's still growing, and they just have to start nibbling at the edges. And then as the next cycle progresses, you have to establish a new group of buyers. Maybe this will be sovereign wealth funds in the future. Maybe this will be central banks. Who knows what the next new crop of buyers might be? But that doesn't happen overnight. We don't just flash crash down to like below 75K Bitcoin and then, we hit the numbers. Like this is kind of like a grueling, month by month where markets go apathetic and mainstream stops talking about crypto and Bitcoin altogether, and they just say, oh, there's another bubble, right? That's how you expect this to play out?
That's the base case, unfortunately, is that, I think there's still probably still some people in the market that are looking at rate cuts and still thinking, that's gonna be, big for risk assets. Maybe it is, it's possible it is. But I think where that depression and sort of the later stages kick in potentially is if you start to see the rate cuts and it's not, we were going to be ending QT, I think, basically very, very soon here. I think this was beginning of December. So that's ending now. I think when that was announced about a month ago, most people thought that was going to be bullish for risk assets. So let's see how that starts to play out. Let's see how the market starts to react to maybe, an announcement on who the next Fed chair is going to be. And I think that's where depression potentially starts to set in, where like these views that people maybe had that were these catalysts would be bullish. If they're not bullish, then that's where you kind of get the capitulation. And, we're already starting to see, it's fascinating to see how the psychology shifts, where I'm seeing a lot of content now about more of the, I don't know if I'm not going to call it FUD, but I think it's actually fair criticism, but like, quantum computing is going to break Bitcoin. These are the types of stories that you see in bear markets. So this is
narrative following price as well, right? All the bearish news, everyone's like, oh, it's because of quantum. That's why price is down, obviously.
Right. So these are the things I'm looking at. And I do think, historically, this cycle did play out, so far has played out similar to last cycle. So I would, my base case is that the bear market probably plays out similar to past bear markets as well. I saw an interesting stat actually on X the other day on midterm years. And I was not aware of this, but since 1926, the average drawdown in a midterm year is 18.2%.
So equities as well?
Yeah, for equities, for the S&P. S&P 500. So for whatever reason, midterm years tend to be bearish. I think the market still thinks that Trump is just going to somehow will the market up.
Which is next year, for those that don't follow U.S. politics. Next year is a midterm year, 2026.
Right. And so next year is a midterm year. Base case is that, probably a bear market for crypto.
Okay. All right. Let's talk about if people want to play this the way TDR is playing it. If they want to, because I've been looking at your work, reading the reports on a weekly basis. We've been doing these episodes. We will continue to do these episodes on Bankless on a monthly basis to update you with everything that's going on in Mike's head. We're actually considering maybe doing a weekly episode here too, and maybe publishing that elsewhere. So Bankless listeners are interested in that. Let us know, because we'll do more of this content, because this is the most energized I think Mike actually is. And he is looking both at this cycle data set. He's also, you're compiling a watch list, I believe, of crypto assets beyond the majors. Right now, that 20% you hold in crypto assets is kind of the majors, right? It's like Bitcoin and a little bit of Ether as well. But during these bear cycles, you like to go down market and find assets with strong fundamentals as you're kind of like resetting everything. And you're saying, okay, like what's going to do well? What looks strong from an on-chain perspective? So you are compiling a watch list on the DeFi report that is available for subscribers of assets that you're essentially putting in this bucket. I don't know if there's going to be 10 to 20 to 30 or so of these that you have not yet taken a position in, but you are watching, and they're of note. So I think you're going to be publishing that for DeFi Report subscribers. But just in general, how are you playing this moving forward in terms of the assets that you're going to allocate to, and how are you keeping your subscribers informed?
Yeah, and this is why I like the bear market. So the watch list is essentially a curated list of projects that in some of these we actually were invested in during this past cycle. These are projects that maybe they came out this cycle, maybe we've had an eye on them for a while, and we're tracking. And when we get into the bear market, we get a lot of signal as to which ones are going to be the ones we think are going to emerge when we get into more bullish conditions. And so that's the watch list that goes out to all of our free subscribers. It's a report that goes out every Friday based on fundamentals. We typically share a data dashboard, a Dune dashboard that goes with that. And what I'm looking for, I guess, broadly within the portfolio is a lot of these sort of fair value metrics that we track for Bitcoin. Is we want to, have clarity on when we were going to buy Bitcoin, when those metrics hit, and then we want to know, which of the products on our watch list are the ones we feel most strongly about, so that we're ready not only to buy Bitcoin, but when we think those other assets are at fair value or below fair value, that we're ready to add those to the portfolio.
So you're looking for entry prices for those assets.
Yeah, exactly. That's the idea, is to put them on the list. Let's track fundamentals. Let's have a view, and then the ones that we think we feel most strongly about get, basically make it into an even smaller list. And those are the ones that we'll be looking to add to the portfolio.
This is effectively what you did during the bear cycle of 2022, I believe, and into 2023. And I think you picked up some big winners, right? Solana was one of those that you noticed in kind of the depths. It's like, hey, there's on-chain activity here. There's stuff going on here. And you bought that on the lows. So are you looking to kind of repeat that level of success?
That's the idea, yes. And, that was an interesting one because at the time, Solana was a new project. It was a little bit harder to have like really strong, fundamentals, but it was more of a bet on the developer ecosystem at the time. And so, yeah, we felt strongly that Solana was just like way, way, way oversold. And that was a big winner coming out of this. We were allocating to assets like Robinhood and Coin, as well as with crypto equities, making it into the portfolio. And that's the idea, is let's find like what we think is the strongest projects that are just wildly oversold, kind of at the bottom of the bear market.
Looking for gems here, Mike. This is going to be a lot of fun, I think. It's got me more energized, even though we are in a bear market. I don't like to look at prices, but we get to do more research. And of course, this asset class, we are both bullish, will be do very well from a long-term perspective. So maybe we will leave it at that. I will be following your work at the DeFi Report. We'll include a link in the show notes. There's an option to be a free subscriber. You get access to the free reports, or a paid subscriber where you get access to 2 weekly reports, all of Mike's portfolio holdings, when he does what, where he's allocated, and also access to some of those watch list assets. So we'll include a link in the show notes for that. Gotta leave you here. Of course, none of this has been financial advice. Crypto is risky. You could lose what you put in, but we are headed west. This is the frontier. It's not for everyone, but we're glad you're with us on the bankless journey. Thanks a lot.